So they are the differences in the ordinary income tax rates. So now let's look at capital gains. So remember what capital gains are. So capital gains are gains that come from growth within your investments. So outside of IRAs, traditional IRAs or Roth IRAs, in your taxable account, that account, remember your buckets here, right? We've got taxable, tax deferred, tax advantaged, or tax free. So these are your IRAs, 401ks, etc. Traditional. Anything tax advantage or tax free, that's anything Roth, and some properly structured cash value life insurance. Kind of here in your taxable bucket is everything else. Your CDs, mutual funds, stocks, bonds. So capital gains, of course, is you buy something at $1,000, it grows to $5,000, or it grows to could grow to $5,000, but let's make it simple. Grows to $1,500. That growth from $1,500 could be taxed at short-term gains if it's below 1 year, or it could be taxed at capital gains, long-term capital gains, which would fall under this type of tax if it's greater than 1 year. And then you have dividends. They're either qualified dividends or ordinary dividends. Ordinary dividends and short-term gains get taxed at these rates up here that we talked about. But if they're qualified dividends or long-term capital gains, they're taxed at these rates down here. And these rates are favorable. They're these capital gain rates. So a really good example is we had a client who bought a stock who had appreciated quite a bit, and he wanted to put a sell order on it if it fell below a certain level. And one of the parameters was, well, let's make sure that we're beyond 12 months so that if I get sold out of this position, that it doesn't add to my taxable income up here. It gets taxed at these preferable rates down here. So these are long-term capital gains, and that's typically greater than 1 year, or qualified dividends. Okay, so you'll see here that these increases are similar. It's about, let's see. I don't have the number here, but it's about the same. It's about 5.48% or 5.4% increase. So to pay zero tax, you were looking at an income of $89,250 compared to the increase, that's for 2023, of $94,050. So that is $4,800 for a married couple and $2,400 for a single couple. Goes from $44,625 to $47,025. Your 15% goes to from $89,251 to $553,850 to $583,750 for a married filing joint couple, and from $492,300 to $518,900 for a single filer. It's a big jump for a single filer. It's also, a big spread for a single filer. We don't see it. The single filers really get hurt with ordinary income, not so much with capital gains. It's a difference, of course, but it's not as great. And then anything over these numbers is taxed at 20%. So that married filing joint amount over 20% over $553,850 jumps to anything over $583,750 for the 20% capital gains or qualified dividend rate. Single filers goes from $492,300 to $518,900. Anything over that, and then that's it, right? That's it. There's only 3 brackets. Don't forget this 3.8% Medicare surcharge, and that is for based on modified adjusted gross income. So that can make this 15%, 18.8%, and this 20%, 3.8%. So these brackets have increased. So that's good. Again, you can have more capital gains, you can have more qualified dividends, and you're going to be taxed at a lesser amount, potentially. But I want to point something out to you before we end for today, because they're the updates for the 2024 tax brackets, capital gains. Oh, did I include? Oh, the standard deduction also went up. Let me grab that before we talk about this next thing. So the standard deduction went from $27,700 to $29,200 right here. So obviously, That's an increase of $1,500 for married couple, $750 for single filers. And if you're over 65, that went up $50 a piece. So from $1,500 here, you seeing that? Yeah. To $1,550 for in 2024, and for single filers that went up a full $100. So from $1,850 to $1,950. So that's good. So that's also your standard deduction. So if you don't have deductions over that amount, everybody at least gets $29,200. If you're married, $14,600 if you're single. And if you're over 65, you get a bit more. And then you see head of household there as well. But back to capital gains, let's talk about this for a second, because this part is really important. Remember, you've got this extra surcharge, this 3.8% surcharge. If you earn over a certain amount, we're going to talk about what that certain amount is in a second. Your capital gains brackets went up, not your percentages, but the amount of income that can fit in those percentage brackets. So that's a good thing. It means you can earn more and potentially pay tax less tax on those earnings. But the thing that triggers that 3.8% surcharge hasn't budged. Let's look at this. So what is that 3.8% surtax? That surcharge based on? Well, it's based on, for 2023, it's based on a modified adjusted gross income. That's what MAGI means, modified adjusted gross income. For a married filing joint couple, that's $250,000. For individuals, that's $200,000. For married filing separate, $125,000. And for trusts and estates, it's $14,450. So I want you to remember that for a second, because I want to slide over here. The only thing that changed in this is the trust and estates. This one's the same, this one's the same, and this one's the same. What does that mean for you? That actually means that more people are going to be subjected to the 3.8% surcharge, because the triggering incomes haven't gone up one iota other than for trusts. And I don't know how many people the trust part affects, but it's much, much less than the individuals. These are, and that because it's the only one that's indexed for inflation. The other ones are not indexed for inflation, which means they're not going to change. They are unlikely to change. These are those phantom tax. This is an example of the phantom tax that these phantom tax increases that are going to happen year over year over year, and Congress doesn't have to do anything for that. More and more people are going to be affected by this. So while the marginal tax brackets, the amounts, the income triggers inside the marginal tax brackets will go up every year, these certain things like this, the 3.8% surcharge, the surtax on net investment income or on qualified dividends, things like that, long-term capital gains, that will stay the same, so more and more people will trigger. I hope that makes sense. The other one that really gets me, so many people are going to be more affected. Their capital gains taxes are going to be greater because of this issue. But the other one is, I think I grabbed that here, provisional income. Yep, it's right down here. So this is the tax, the provisional income, if you might remember, and we'll talk about this in our class. That's the income that the IRS that tracks to determine how much of your Social Security is subject to tax. So you can see the numbers here. So modified adjustment gross income, same thing that's tracked on the Medicare surcharge, right, that I just talked about. Modified adjusted gross income up to 50% taxable. So anything below these thresholds is zero tax on your Social Security. But once you cross over $32,000 if you're married, to $44,000, up to 50% of your Social Security is subject to tax. If you're single, once you cross over $25,000 in modified adjusted gross income, up to $34,000, up to 50% of your Social Security is subject to tax. Then it gets worse, up to 85% of your Social Security is subject to tax once you cross over $44,000 of modified adjusted gross income for a married couple, and $34,000 of modified adjusted gross income for a single filer. And this table is not adjusted for inflation, just like the Medicare surcharge, net investment and investment income chart that I showed you, not adjusted for inflation, which means it's been the same for years. It's not going to increase. And more people are going to be subject to higher tax rates in their capital gains and higher tax rates, more tax on their Social Security. So watch out for that. While it's good news up here, folks, that these Roth corridors, Roth conversion corridors we talked about, that we can move more money over to Roth IRAs via conversion, because now we top out for a married couple at $383,900 compared to $364,200. That's all good news for capital gains. Again, good news. You can stay in the 15% bracket for capital gains tax, long-term capital gains and qualified dividends up to $583,750 for a married couple compared to $553,850 in 2023. That's good, but the Medicare surcharge is going to hit more people sooner because their incomes are going to go up above the $250,000 modified adjusted gross income. And you're going to start seeing that 3.8%. So, and then, of course, Social Security. More and more people are subject to tax on their Social Security because those provisional income rates have not changed since I've been focusing on tax-efficient planning. Doug asked another question. What is qualified dividend and how to find them? So qualified dividends are, it's not like a waiting period or anything like that, Doug. It's a dividend that comes from a position, whether it's a mutual fund, a business development company, closed-end fund, or an individual stock. It's how it's set up. So the dividend is going to be qualified or it's not going to be qualified, and that'll be either on the investor relations information. If you call investor relations for the company or you look at their website, your custodian should be able to tell you, and certainly your advisor should be able to tell you. So if you have any questions, contact me directly at questions@attleborowealth.com, or that's questions@attleborowealth.com, or Doug, you can email me directly. Okay, folks, that was a lot of information. It's 11:02. It's good to see you all back. We'll be back next week, and we're going to continue down this road of updates for 2024. If you're a client, you need to reach out to us. You have our contact information. If you are not a client and you want to schedule time with me, you can reach out to us at questions@attleborowealth.com, and you can ask we'll help you find a time that works for us. Thanks, everybody. Have a great week. We'll see you soon. Take care.